Welcome to Money Finance. In today's video, we are going to talk what you need to know about crypto taxes in 2025. Cryptocurrency taxation has been a complex and evolving topic for years. As we step into the year 2025, governments worldwide are refining regulations to ensure compliance and maximize tax revenue. Whether you're an investor, trader, or casual crypto user, staying informed about these changes is crucial to avoid penalties and optimize your tax strategies. In this video, we'll break down the fundamental changes in cryptocurrency taxation for 2025, including new tax brackets, reporting requirements, and how different countries are approaching crypto taxation. Don't forget to subscribe and turn on notifications for more videos about finance. So let's start. Global taxation trends in 2025. Governments have been tightening their grip on crypto assets, recognizing them as a significant source of untapped tax revenue. Some key global trends shaping crypto taxation this year include stricter reporting requirements. Many countries now mandate centralized exchanges to report user transactions directly to tax authorities. This makes it more challenging to hide crypto earnings and increases the likelihood of audits. Higher tax rates for short-term gains. Short-term crypto trades, held for less than a year, are subject to higher tax rates in multiple jurisdictions, aligning them with traditional capital gains taxes. Taxation of staking and yield farming rewards. As DeFi platforms and staking services continue to grow, regulators are focusing on taxing these passive income streams. NFT and metaverse taxation. Non-fungible tokens, NFTs, and virtual assets in metaverse economies are now under scrutiny, with tax agencies determining how to classify and tax these digital assets. The United States and crypto tax changes. The Internal Revenue Service, IRS, has implemented several key updates to cryptocurrency taxation in 2025. 1. Mandatory reporting for exchanges and wallets. Centralized exchanges are now required to issue Form 1099-DA to all users who have transacted over a certain threshold. Decentralized platforms with US users are under pressure to implement similar reporting mechanisms. 2. Updated capital gains tax rates. Short-term capital gains, assets held for less than 12 months, are taxed as ordinary income, with rates ranging from 10 to 37%, depending on income level. Long-term gains, held for more than a year, benefit from lower rates, ranging between 0 and 20%. 3. Mining and staking income taxation. Any crypto earned through mining or staking is considered taxable income at the time of receipt. Miners must now report energy costs separately to determine deductible expenses. 4. Crypto-to-crypto transactions are taxable events. Swapping one cryptocurrency for another, e.g., Bitcoin for Ethereum, triggers a taxable event, requiring users to report gains or losses. Europe has stricter rules across the EU. The European Union has introduced a uniform framework for crypto taxation under the DAC 8 directive, which impacts all member states. 1. Mandatory crypto asset reporting. Exchanges operating in the EU must now share transaction data with tax authorities, similar to banking regulations. Failure to comply results in severe penalties for both platforms and individual users. 2. Capital gains taxation on crypto. Most EU nations now apply capital gains taxes on crypto profits, typically ranging between 20 and 35%. Some countries, like Germany, still offer tax exemptions if assets are held for over 1 year. 3. Stablecoin regulation and taxation. Stablecoins are now subject to taxation rules similar to fiat holdings, particularly when used for payments or converted into traditional currency. Asia, regulatory tightening in major markets. Countries across Asia are also reinforcing their stance on crypto taxation. Japan maintains a progressive tax system for crypto earnings, with rates reaching up to 55% for high-income individuals. South Korea implements a flat 22% tax on crypto gains exceeding a predefined threshold. India continues its harsh stance with a 30% tax on all crypto gains and a 1% tax deducted at source, TDS, on every transaction. Crypto taxation in emerging markets. While developed nations enforce stricter regulations, some emerging markets are taking a different approach. El Salvador continues offering tax exemptions for Bitcoin-related activities to attract foreign investment. United Arab Emirates provides tax-friendly conditions for crypto businesses operating in designated free zones. Nigeria introduces a progressive tax structure but faces challenges in enforcement due to high levels of peer-to-peer trading. What this means for crypto investors. With tax authorities worldwide increasing oversight, crypto investors must be more diligent than ever. Key takeaways include: keep accurate records. Ensure all transactions, trades, and earnings are well documented to avoid discrepancies during tax filings. Use tax software. Platforms like Coinly and CoinTracker help automate tax calculations and ensure compliance. Consult a professional. Given the complexity of crypto taxes, seeking advice from a tax expert can help minimize liabilities and prevent legal issues. What's next? Crypto taxation in 2025 is more comprehensive and stringent than ever before. Investors must stay proactive in understanding their obligations to avoid fines and maximize tax benefits. In the next episode, we'll dive deeper into crypto tax loopholes, legal ways to reduce your tax burden, and how decentralized finance, DeFi, is reshaping tax strategies. So far we have covered the major changes in cryptocurrency taxation for 2025, including stricter reporting requirements, higher tax rates for short-term gains, and global regulatory trends. Now, we'll dive into the legal ways to reduce your crypto tax burden, the loopholes that still exist, and how decentralized finance, DeFi, is reshaping tax strategies. While tax laws have become more stringent, there are still several ways to legally optimize your tax liabilities. However, as regulations evolve, some strategies may soon be phased out. Let's break them down. Legal ways to reduce your crypto taxes. 1. Long-term holding for lower tax rates. One of the simplest and most effective ways to minimize crypto taxes is to hold assets for more than 1 year before selling. Why it matters? In many countries, including the United States and parts of Europe, long-term capital gains are taxed at significantly lower rates than short-term gains. For example, if you sell Bitcoin after holding it for 6 months, you'll pay a tax rate as high as 37% in the US. But if you hold for more than 1 year, the rate drops to a maximum of 20%. Pro tip: if you plan on making large crypto investments, consider a long-term strategy rather than frequent short-term trading. 2. Tax loss harvesting. Tax loss harvesting is a popular method among investors to reduce taxable income by offsetting gains with losses. How it works: if you sell a cryptocurrency at a loss, you can use that loss to offset your taxable gains. For example, if you made $10,000 in profit from Ethereum but lost $5,000 on Solana, you only need to pay taxes on the net gain of $5,000. Important note: some countries, like the US, have introduced wash sale rules for stocks, which prevent you from selling and rebuying the same asset immediately to claim a loss. However, these rules haven't yet been fully applied to crypto, but this could change soon. 3. Gifting and donating crypto. Instead of selling crypto and paying capital gains taxes, consider gifting or donating it to reduce tax liabilities. Crypto donations. Many countries allow tax deductions for crypto donations to registered charities. Gifting crypto. In certain jurisdictions, gifting crypto to family members below a specific value threshold is tax-free. For example, in the US, you can gift up to $17,000 per person per year without triggering taxes. 4. Relocating to a crypto-friendly jurisdiction. Some investors are taking drastic steps to relocate to countries with little or no crypto taxes. Tax havens. Countries like Portugal, the United Arab Emirates, and El Salvador offer tax incentives for crypto investors. Residency programs. Some nations provide special visas or residency programs for crypto entrepreneurs and high-net-worth individuals. For example, Portugal, previously a tax-free haven for crypto, has introduced some new regulations, but long-term holders may still benefit. Warning: before moving, ensure you understand exit taxes, which some countries charge when relocating assets abroad. 5. Using crypto retirement accounts. In certain countries, you can hold crypto within tax-advantaged retirement accounts to defer or eliminate taxes. US example: Investing in crypto through a self-directed IRA or Roth IRA can provide long-term tax benefits. Gains inside these accounts grow tax-free or tax-deferred, depending on the account type. This strategy requires careful planning but can be a game-changer for long-term investors. Crypto tax loopholes that still exist for now. As regulations tighten, some tax loopholes remain, at least temporarily. However, these strategies may be phased out soon, so exercise caution when using them. 1. Offshore crypto accounts. Some investors use offshore accounts in tax-friendly nations to reduce liabilities. Risk. Many countries are cracking down on offshore holdings and increasing transparency requirements. 2. DeFi transactions in non-compliant protocols. Some decentralized exchanges, DEXs, and DeFi protocols do not report user activity to tax authorities. Risk. Governments are increasingly targeting DeFi, and new laws may soon enforce reporting on decentralized platforms. 3. Wrapping and tokenizing assets. Certain investors wrap assets, e.g., wrapping Bitcoin into WBTC, to potentially delay taxable events. Risk. If authorities classify these transactions as taxable, you may still owe taxes. Important note, many loopholes that worked in the past are closing rapidly. Governments are enhancing blockchain tracking tools to catch tax evaders. The future of crypto taxation and DeFi challenges. DeFi and tax complexity. Decentralized finance, DeFi, presents significant tax challenges because many DeFi transactions, such as staking, yield farming, and lending, generate taxable income. Unlike centralized exchanges, DeFi platforms do not always issue tax reports, making it harder for users to track gains and losses. Some governments are working on laws that will require DeFi protocols to report user data, similar to centralized platforms. How to stay compliant in a rapidly changing environment. With crypto tax laws evolving, investors must take proactive steps. Use crypto tax software. Platforms like CoinTracker, Coinly, and TokenTax help automate tax reporting. Keep detailed records. Save all transaction history, including timestamps, amounts, and wallet addresses. Stay updated on regulations. Follow news from regulatory agencies like the IRS, European Commission, and local tax authorities. Consult a tax professional. A crypto-savvy accountant can help you minimize liabilities and avoid compliance issues. Crypto taxation in 2025 is more complex than ever, with stricter reporting requirements, higher tax rates, and growing enforcement efforts. However, there are still legal ways to reduce your tax burden, from long-term holding to strategic gifting and tax loss harvesting. At the same time, governments are closing loopholes and increasing oversight, especially in the DeFi sector. The best approach is to stay informed, use tracking tools, and seek professional advice to navigate this evolving landscape. What are your thoughts on these new tax rules? Do you think crypto should be taxed differently? Let us know in the comments.